why this structure kills exits and blows up deals. This is the video people don't realise they need until it's already too late. Because everything I've talked about so far, structure, clearance, sequencing, behaviour, all of that is annoying but survivable while you're just trading. This is where it stops being survivable. This is what happens when you try to sell a business, raise money, bring in investors, refinance, or even just get taken seriously. And your structure looks fine on paper, but your history is a mess. And this is where deals don't explode loudly, they just die. People think exits fail because the numbers weren't good enough. They rarely do. They fail because risk shows up, and buyers do not tolerate unknown risk. And most founders don't realise how much risk they've accidentally created until someone else starts asking questions. And let me say this up front, because this is where people get defensive. An exit is not about your growth story. It's not about your pitch deck. It's not about how hard you worked. An exit is about removing uncertainty. Buyers are not optimistic, they are suspicious by default. Their entire job is to assume you're either sloppy or hiding something until proven otherwise. So when people tell me they're thinking about an exit, my first thought isn't great. It's has anyone ever actually looked under the bonnet properly, because that's where it usually falls apart. This is how it normally starts. Someone's been running a group for a few years, holding company on top, one or two trading companies underneath. It looks grown up, it looks sensible. Everyone feels quite pleased with themselves. Then interest appears, an investor, a buyer, a conversation, and the founder thinks, perfect, we're structured, this should be easy. That's the moment they are wrong, because the very first thing that happens is not excitement, it's due diligence. And due diligence does not care about your fucking diagram. The first requests are boring. Accounts, intercompany balances, loan agreements, dividend history, director transactions, share transfers, bank statements. This is where the mood changes, because this is the first time anyone has looked at behaviour, not structure. And behaviour is where most groups quietly unravel. Let's talk about intercompany balances, because this alone kills a frightening number of deals. On paper, everything looks fine, but then diligence shows that money has been bouncing between companies for years. Trading company owes the holding company, then the holding company owes the trading company, and then it flips again with no clear reason, no consistent explanation, no proper agreements. And then the buyer asks one simple question: why did this money move? And this is where people panic, because the honest answer is usually it was temporary, or it was just to help cash flow, or it didn't really matter because it's all the same group. Temporary for 3 years is not temporary, that's unmanaged. And from a buyer's point of view, this doesn't look like flexibility, it looks like weak controls. Weak controls equal risk. Risk equals either a lower price or no deal at all. This is the bit people don't understand. Buyers don't accept explanations, they accept evidence. If something isn't documented properly, it didn't happen properly. If behaviour looks inconsistent, something is assumed to be wrong. They don't care that your accountant wasn't worried. They care whether they could inherit a problem later. And if the answer is maybe, they protect themselves, always. Directors' loans accounts are another silent killer. People treat them casually for years. Money comes out, money goes back, nobody's too stressed about it. Then an exit appears. Suddenly the buyer is staring at an overdrawn director's loan that's been there for ages. They start asking questions. Is it repayable? Is it remuneration? Is there tax exposure? Is it recoverable? And the seller says, oh, it's never been an issue before. It's never been an issue because nobody had money on the line before. Now they do. So what happens? Either the loan has to be cleared before sale, which means cash suddenly needs to appear, or the buyer reduces the price and they insist on retention. And this is where founders get angry, because it feels unfair. But it's not new, it's just newly visible. This is the line I always come back to. Due diligence does not create problems, it reveals them. If behaviour hasn't matched structure for years, exits expose that brutally. And this is why people feel blindsided, because nothing went wrong day to day until it mattered. Now let's talk about warranties, because this is where it gets properly serious. When you sell a business, you give warranties. You are legally stating that the accounts are accurate, transactions are properly recorded, there are no undisclosed liabilities. If your group behaviour has been sloppy, those warranties become dangerous, because now it's not just about losing some money on price, it's about legal exposure after the sale. This is why buyers push for indemnities. retentions, earnouts. They're not being difficult. They're pricing in the risk of your past behaviour. And if you think that that doesn't matter, wait until a warranty claim lands after you thought you were done. This is also where investors quietly disappear. This one hurts people's egos the most. The meetings go well, everyone's enthusiastic, then nothing. No feedback, no follow-up, just silence. What actually happened is very simple. The investors' advisors looked properly and they saw unclear ownership history, messy intercompany flows, behaviour that didn't line up with the structure, and they decided it just wasn't worth the effort. So they walked. No drama, no explanation, just gone. At this point, people usually say, well, we'll just tidy it up before we sell. No, you can't. Once diligence starts, it's too late. Anything you fix under scrutiny looks suspicious. Buyers don't want a clean-up. They want consistency. You can't rewrite years of behaviour when someone's watching. That's why this stuff has to be right long before an exit is even on the table. This is the real cost of getting it wrong. Not just delay, but reduced valuation and dragged out deals and a load of stress. Momentum dies, and when momentum dies, deals die with it. This is why the last video mattered. You don't lose exits because your structure was wrong. You lose exits because you changed the paperwork and kept acting the same. You treated it like a sole trader. Structure without discipline is just cosmetic, and buyers can smell that instantly. If you're still watching this and thinking, why does nobody tell people this early? Subscribe, because this channel exists purely to explain the bits people usually learn the expensive way. And this is exactly why I've got the tax game plan. The link to that is in the description. That will help you get the foundations right. And if you're running a group now and even vaguely thinking about selling, raising or refinancing in the next few years, book a call. Not to talk about the valuation, not to talk about growth hacks, but to remove the risk. That's the work that protects exits. The link for that is below. Book a call on my diary. I'll finish on this. Most exits don't fail loudly. They fail quietly behind the scenes because someone didn't like what they saw when they looked properly. If you want optionality later, you need discipline now. In the next video, I'll show you what buyers actually want to see when a group is clean and why it's boring as hell. Don't forget to subscribe and like this video.